Hello, my name is Miles Merwin with Advisors Insurance Agency. Today, I want to take a moment to talk about the ARC system. Did you know that there's 4 ways to handle risk, not just one? See, most insurance professionals, if that's what you want to call them, they only talk about the 4th way to handle risk: transferring risk to an insurance carrier at a premium. A high premium, usually, right? That's the way it feels. Well, there's actually 3 other ways to manage risk. Number one is avoid. Remove the risk altogether. So, depending on whether you're a business owner or this is for your personal insurance program, there's many ways to avoid risk. One would be, don't let your teenage driver start driving until they're 18 versus 15. Now, it might be inconvenient, but you're going to avoid some risk for a while, right? Don't put a pool in your backyard. Don't have a trampoline in your backyard. If it's a commercial, if you're a business owner, maybe there's certain products that you provide or services you provide for your customers that aren't very profitable that add additional risk. One good example I can think of is a lawn care provider who additionally will cut down trees. Well, cutting down trees is extremely risky. If that's not your main source of income, it could significantly increase your insurance expenses for an area that you're not specialized in. So avoid that risk altogether to keep your insurance premiums low, right? So there's a certain way to avoid. Another example would be rent versus own. If you rent a building or a home or an apartment, you're not as liable for certain types of things like storm damage. And so it reduces that avoids risk, right? Because someone else has to fix it, not you. Next one, reduce. Minimize the likelihood and severity of a perilous event. Now that sounds complicated, but let's talk about what it looks like to reduce risk. Insurance companies make businesses and individuals do this all the time. So if you have a pool in your backyard, the insurance carrier is going to require you to have a 4-foot fence with an automatic latching gate. That's a risk reduction measure. If you have a trampoline in your backyard, most insurance carriers now require you to have a net. Risk reduction. If you're a business owner in the restaurant space, you may require your employees to wear slip-resistant shoes. That is also a risk reduction measure. If you're a homeowner, you might be able to add an automatic water shutoff valve. So that way, if your pipes burst and water starts rushing, that system will automatically shut off your water system to reduce the damage that happens in your home. So start thinking, what would it look like to reduce some risk in my business or in my residence? The next one is retain. Willingness to pay out of pocket for a perilous event. Now, the easiest way to think of retaining risk is through your deductible. We're all retaining some sort of risk. We have a $500 or $1,000 or $2,500 deductible on our business insurance or on our auto insurance or our home insurance, right? But start thinking about what it looks like to retain other risks. There's risks that you probably retain you're not even aware of, like flooding. Many of our insureds do not carry flood insurance, and so that is a risk that you completely retain. Earthquakes. We've had some earthquake activity in the upstate of South Carolina recently, and many people do not carry earthquake insurance. And I'm not trying to sell you earthquake insurance. I'm just telling you that is a risk that you have decided, whether intentionally or not, to retain. What other risks are you willing to retain in life to help save you money? A risk that I personally retain all the time is I do not buy warranties. I don't buy home warranties. I don't buy warranties on televisions, on cars, nothing. The likelihood of me having to use a warranty is low. And if I do need to, all the money that I save from not buying warranties, if I've just saved that up, typically I've got enough money in my savings account to cover those types of things. So I have chosen to retain the risk of malfunctioning products that I've purchased. All right, the very last one. I know that you know all about this one, transferring risk to an insurance carrier. So at this point is when you've called someone like myself or someone on my team or another professional in your area, and you have asked them for quotes to transfer risk to an insurance carrier at a price. What's that going to cost to do that? Now, this is a very normal way to handle risk, and business flows transferring risk back and forth all day long. There's big money in transferring risk, but you need to decide, which risks do you have in life or in your business? Which ones are you willing to or can avoid? Which ones can you reduce? Which ones are you willing to retain? And then what is left that you would like to transfer to an insurance carrier at a premium? If you'd like to talk about your ART program, please feel free to give one of our team members a call to discuss what it looks like to build out a risk management strategy that includes avoiding, reducing, retaining, and transferring risk. Thank you so much.